a deal bank financed with another investor where all of the money came from the bank and the other investor. Welcome to Multifamily Strategy. Today we're sharing 2 ways you can use a bank to buy deals $0 down. That's right. No money out of pocket, still using a bank. Now we talk a ton about creative finance on this channel. However, we rarely talk about bank finance. We're going to go into that today. Hey, welcome back to the channel. My name's Christian. I have bought hundreds of multifamily properties, starting with $0 and using $0 built the portfolio that I have today. In doing that, I've used a lot of seller finance, general creative finance partners, and sometimes banks. There are 2 different ways that are very reliable to buy a property with bank debt that I've done before. You buy it with a bank, but no money leaves your pocket. We're going to talk about one of them right now, which is a blend of bank and seller financing. Now, we love seller financing. If a seller will do 100% seller financing for me, I'll do that deal every day of the week, as long as it cash flows on long-term fixed rate debt. However, that's not usually the case. In some deals, it's either not possible to do seller financing, they don't have the equity to do them, they being the seller, or it's a deal where that's just not what they want to do. Sometimes the seller does in fact want to be cashed out at this time. So if you have a deal where you win on price, because the bank's going to want an appraisal, and you have enough stability, because they're going to look at the debt service coverage ratio and go, okay, do you have enough income to cover the debt plus a little extra to sock away every month? They want to see that you can meet that mortgage again and again and again out of the cash flow of the property. If you hit those requirements, you can use the bank. A seller's second is something that a seller may not want to do, and here's why. In second position, you only get paid after the first position note is paid off. So on a deal where maybe you're not winning on price, if you're getting a seller to carry a second position note, but the whole first position note that the bank has isn't paid off, they may not get paid. Your risk is higher in second position. However, what we ask is, are they able to do a lower amount, say 25%, 20%? I've seen banks go beyond that, but it's very rare. If you have a bank that will do 75%, there are banks, usually local banks or local credit unions, even better, will allow the seller to carry a second. And there are multiple banks that you can come in, show your track record as an operator, and you can show, hey, look at, if you'll do 75%, I have a seller who will carry a second and 25. Do you need me to bring extra money to the table? Some banks will say, yes, we would like to see at least X amount down. Some banks will say, nope, the money's all here. We don't need you to write a check. We like our position of 70%. This looks good. Seller carry of 30%, we're golden. There's another way that you can blend this. You can do what's called a 50, 40, 10. The bank does 50% because all banks love that leverage point in first. The seller comes in second with 40%. If it's a bank that requires some skin in the game from you, you can contribute towards that 10%. Now, what if you actually have no money, so you can't put that 10% down? Or what if you have a deal where you have a fantastic win on price? You have an amazing deal. You have a bank that wants to lend on it, but they're requiring 30% down and you don't have the money. Both can be answered with an equity partner. Now, general rules of the game. We've already talked about appraisal. So banks are going to want to see that you're buying it at a good price, less than the property is worth. And they want to see that you have a debt service coverage ratio. It's usually of 1.25. And all that means is after all expenses are paid, you have like operating expenses. All of your operating expenses are paid. You have 1.25 times your mortgage amount coming in anticipated cash flow on that deal. That is what the debt service coverage ratio is. After all expenses are paid, how much is left to service your debt and pay yourself? 1.25% is where a lot of banks like to see that. It's a pretty safe metric. So now that we've covered those, what else does the bank want to see? They want to see that the partners all have good credit scores and your group, so all of the investors in your deal, have a combined net worth of at least the loan amount. If they're going to lend you $2 million, as a party, you all better be worth cumulatively $1 million. Now, this has allowed me to scale into larger and larger deals. When you're starting, you may not qualify for the bank debt because you are starting at a lower net worth than the deal that you found. Awesome. Bring in the equity partner. They can bring in all of the money, and you will structure a deal, and I'll talk about a couple different structures, but you will structure a deal in the operating agreement of how cash is going to be returned to them and how they're going to get their return on their money. But day one, you can buy a deal bank financed with another investor where all of the money came from the bank and the other investor. You have not moved a single dime, but what you did is you lined up the deal, you worked with the bank and found the debt, and you found the partner to bring in the equity. With deal, then debt, then equity found, you've now completed a transaction. Congratulations, you own real estate without spending a dime. You've done a lot of work, and there's a lot of work ahead of you, but you've done step one. You own the real estate. You do have to remember step two is, how do I keep it? So we better have a good way to pay off our investor. Now, the goal here is to own all of our real estate. I don't want an army of investors. That sounds horrible. I don't want a ton of partners. People are variables. You don't want variables in your financial freedom. However, if you have an amazing deal, you better figure out a way to close it. So now that I have the cash flow, now that I have the deal, now I have this investor here, I need to know what that investor's goals are. If their goal is cash flow and we have a deal that has a ton of cash flow day one, it's actually better to bring them on as a debt partner. Unless you needed them to qualify for the bank, just borrow the money. If the deal can support it, you did deal debt done. That's fantastic. If you needed them to qualify for the loan or otherwise don't have the cash flow to pay them out monthly, you're looking for an investor who wants a larger return in the future. You're looking for a deal that has some value add, where at a future date, say 5 years down the road, you can give them a multiple of their money. It's not going to drain cash flow today, but what it's going to do is going to give you time to get through your project, to increase the value of the property, and to write them a check in the future. I've done that on many properties, including one of the first ones we ever purchased, the 38-plex. It had a bad roof, it had a bad septic system. Seller financing was the only way to take it out. So that was our debt product. But the partnership was bought out the same way that you would do on a bank deal. They came in, $300,000 in the deal. We bought them out at $600,000. The deal, by the way, made $2 million because we fixed that bad roof. We fixed collections. We fixed the drain field. We made the campus great again. And because we fixed it, we were rewarded with way more money than it cost to buy out the investors. Today, that's property that we own without additional partners. We did this in another deal in Texas, 26-plex. This is bank financed. The bank wrote the loan. It was 80% loan to value. The other 20% came from an investor out of California. He wanted a longer term horizon. And he said, hey, let's actually build a bigger portfolio of 100 units. And this will be one along our journey. And at year 10, we're going to trade buildings around and we will break up the partnership based on appraised value. So we do have an exit strategy. But their goal was, let's build a cash flowing portfolio together. Structure your partnership in a way that makes sense to your investors. But I want to point out, both of those deals, cash flow day one, they pay us checks every single month, and they cost us exactly $0 out of pocket. Real estate is fairly simple. It's also very hard. Definitely not easy. Very, very simple. You can learn how to do these techniques. If you're looking for someone to coach you and guide you through this, I volunteer, multifamilystrategy.com. Check it out. We do have coaching and mentorship there. If not, go ahead and just like and subscribe to this channel. Follow along the journey. If you have any questions, go ahead and reach out to me here in the video or on Instagram at Christian Osgood. See you all on the next episode.